Hi, this is part one of how to prepare a corporate tax return. In this part, we're going to look at the process of setting up a corporate tax return and preparing it. In part two, we're going to look at some specific calculations of M1 items and other book tax differences. So let's get started. Preparing a corporate tax return is all about taking the numbers from your books and records and transferring them over to a tax return so that they conform with tax law. Section 446A gets the ball rolling by instructing taxpayers to use the method of accounting that they use on their own books and records to start. So whatever method your company is using for accounting, start there. Section 446B immediately qualifies this, however, and states that whatever method of accounting you're using, it must clearly reflect income. And guess who gets to decide what clearly reflects income? The IRS. The IRS is required to be reasonable, however, and it generally accepts most common accounting methods, such as GAAP, generally accepted accounting principles, the accrual method, the cash method, and other common accounting methods. In fact, if your company is following a common accounting method, by the time you're done, you're 85% there in completing a corporate tax return. The majority of the work is just keeping accurate books and records under a common accounting system. Once you've got good financial statements, the rest of the work is just finding the specific differences that translate what you have on your books to what can show up on the tax return. For example, maybe you have a $100 expense on your books, but tax law says it can only be $80 on your tax return. Let's see how this might work in practice. Let's say your company is keeping its accounting records on QuickBooks. You're using most of the common accounting methods. It's not totally GAAP, but it works for you and you get good information from your financial statements. In our example, let's assume you have a January 31st year end. You've closed out your books and now you're ready to start the corporate tax return. What do you do next? Here we are at QuickBooks Online. Let's start by taking a look at your financial statements for the January 31st year end 2026. I'd go to Reports, click Standard Reports, and then go take a look at the balance sheet. Once we have the balance sheet, we want to make sure we're getting the proper year end, so let's go over and click on Last Fiscal Year. And there we have it. We can kind of scan through and see what our balance sheet at year end is going to look like. This is the first year for this company, so when we finally make it down to the equity section, we're going to see something. And that something is retained earnings. Notice it's zero. It's zero because there are no prior years. Now let's take a look at the income statement. We'll go back over to Reports and click Profit and Loss. Again, let's make sure we've got the right time period, so let's click Last Fiscal Year, and that will bring up the year ending January 31st, 2026. As we scroll down, we can see the revenues and the expenses, and finally we can see the current book income of $771,000. This is all very interesting, but what most tax preparers do is to put these numbers into a trial balance. So let's go back to the Reports section of QuickBooks and scroll all the way down till we get to the Accountants section. And in there, we will find a choice for trial balance. Let's click that and get a trial balance for these numbers. Again, let's pick Last Fiscal Year. And now we have a trial balance in which all of the accounts are listed with their balances as either debits or credits. And we can see at the end that all the debits and credits will add up to being equal. And this we can download and use to create the numbers we need for the tax return. So let's scroll back up to the top of this trial balance, and on QuickBooks there is an option where you can download this report as an Excel file. So let's go over and click on that option, and let's choose Download as Excel, and now we will get the Excel file for the trial balance. The downloaded Excel file looks like this. We have all the accounts listed for the right fiscal year, and all the balances of the accounts are listed as either debits or credits in the correct column. We're going to take this trial balance and we're going to modify it a little bit so it's a little bit easier to use for our purposes. What I've done here is maintain the basic structure of the trial balance with columns for debits and credits for each of the accounts, but I've separated it into balance sheet and income statement. To keep the balance sheet in balance, I'm going to summarize the income statement with one line for current income down at the bottom. On the balance sheet portion of the trial balance, you can see all the accounts are listed and all the debit account balances are showing debits in the debit column, and all the credit balance accounts are showing credit balances in the credit column. Again, we keep the balance sheet debits and credits in balance by showing one line that summarizes the income statement under current income. I've separated the income statement accounts into the second part of the trial balance. This shows all the revenues and the expenses. Note that there are more credits than debits, so there is a net profit. I show this in the line just below that says net profit before the dividends received deduction. The $771,000 of profit is the number that gets carried up to the balance sheet to keep the balance sheet in sync. So now we're ready to finish out our books, to get our books where we're comfortable with them. They don't need to strictly follow generally accepted accounting principles, but they do need to follow common methods and accurately present what the company is doing. To get our books to this point, we're going to scan through all the accounts and look for mistakes or things that we haven't fixed yet. For ReviewCo, this means we want to keep our numbers as close to the numbers that will be on the tax return as possible, yet still accurately reflect the economics of the company. Any errors or omissions we see on our books, we can correct by using adjusting journal entries. Let's add a couple of more columns for these adjusting journal entries. And as you can see, we've identified some mistakes that need to be corrected. On the balance sheet, we haven't increased the computer and printing press accumulated depreciation for this year's current depreciation expense. Also, we haven't recorded this year's amortization of the organizational costs. I want to point out here that ReviewCo has decided not to follow generally accepted accounting principles for depreciation expense or for the amortization. Instead, ReviewCo wants to record depreciation and amortization according to tax law on their financial statements. This is fine. There's nothing wrong with that. It's not GAAP, but it works just fine for their financial statements, and that's what they've done. We've noticed something else on the balance sheet. Both the banknote payable on the printing press and the computer loan, the balances at the end of the year are incorrect. We've compared these balances with the statements from the bank, and we've compared them with an amortization schedule, and we see that a mistake was made when we entered the payments on each note during the year. Our analysis reveals that the banknote payable for the printing press is $22,000 too low, and that the computer loan balance is $854 too low. So we need 2 more adjusting journal entries to fix the books. We found that the offsetting debits to these 2 entries represented interest expense that was also not recorded. We'll see that in a moment when we get to the income statement. A fifth adjusting journal entry is for the federal income tax payable. Now in this entry, we're not following generally accepted accounting principles. We're following a method that's commonly used by a lot of small companies, where the company will calculate the actual federal tax liability according to the tax return, and then accrue that as the federal income tax and federal income tax payable for the books. That's not GAAP, but again, that's fine. It works for this company. Let's move on down to the income statement portion of the trial balance, and let's take a look at the other sides of the entries. Here you can see the debit side of these adjusting journal entries. The additional interest expense that was recorded, the depreciation expense, the amortization expense, and the federal tax expense that was recorded in the adjusting journal entries. Also notice the net effect on income of these adjusting journal entries. It reduced net income by $293,000. Normally, we summarize these adjusting journal entries on a separate schedule. Then we will give this schedule to the company so they can upgrade their books to reflect these adjusting journal entries, or if we're doing it, we'll make the journal entries ourselves on QuickBooks or whatever accounting software we're using. This will finalize our books and make our books correct. We haven't done the tax return yet. At this point, what we've tried to do is get a correct set of financial statements, both balance sheet and income statement. When we make these adjusting journal entries, we are going to convert the unadjusted trial balance into the adjusted trial balance. As far as the balance sheet goes, this is what we need for the tax return. The adjusted trial balance numbers for the balance sheet will transfer directly to the tax return, Form 1120. Notice that in this example, there are no retained earnings. The reason for that is that this is the first year of ReviewCo, so there is no retained earnings yet. Retained earnings is actually represented here by the current income minus the distribution to the owners. Let's move down and take a look at the income statement. It is a different story. Although the adjusted trial balance gives us the correct revenues and expenses for financial statements, it doesn't give us all the correct numbers for the tax return. For that, we have to look at specific differences between the book numbers that we have here and the numbers that are allowed to show up on the tax return. So now we've got our book numbers correct. We've got them where we want them. Those numbers have been set in stone with our adjusting journal entries. Our next step is to take those numbers and make them acceptable for the tax return. We do that using M1 items and book tax adjustments. We'll go through the actual calculation of M1 adjustments in the next video, part 2. For purposes of this video, let's focus on the process once we've identified the M1 adjustments. Let's go back to our Excel spreadsheet. We're going to focus on the income statement now, and we're going to start with the adjusted trial balance. Now we've got another column, the M1 adjustment column. Here we're going to put in all the book tax differences we need to make before getting to numbers that are acceptable for the tax return. The first M1 adjustment we find is for short-term capital losses. Since we can only deduct capital losses to the extent we have capital gains, we are disallowed $1,500 of the capital loss deduction. We want to show the full amount of capital losses on the books, $12,100, but we're only allowed to deduct $10,600 on the tax return, hence a book tax difference, or an M1 item, of $1,500. Our next M1 item are charitable contributions. On the books, we want to deduct the full $100,000, but on the tax return, we can only deduct around $72,000. Hence, we have another M1 item of $27,732. Next, we have three items that are fully deductible on the books, but not deductible at all on the tax return. We have an M1 item for officer's life insurance for Dewey, entertainment expenses, and federal income tax, none of which are deductible on a federal income tax return. So it creates three M1 adjustments. Finally, we have an item that's fully deductible on the tax return, but not deductible on the books. That's the DRD, or dividends received deduction. The dividends received deduction is a book tax difference, but it's not included as an M1 item. It's shown separately on the tax return. Sometimes it's helpful to summarize these M1 items. I've got 4 of them listed here. The only one that I'm not showing is the federal income tax. Also on the lower part of the screen, there's the calculation for the limitation on charitable contribution deductions, but we'll spend more time on this in part 2 of this video. So now let's go back to our overall spreadsheet. Let's start with the income statement, and let's take the final numbers after the M1 adjustments, and we're going to move them over to page 1 of the Form 1120 right here. Now let's move up to the balance sheet portion of our spreadsheet, and let's take our final balance sheet numbers and move them over to page 6 of the Form 1120. Once we've moved our numbers over, our page 1 of the form should look like this. Our taxable income on the tax return is $649,915. That has to equal what we have on our spreadsheet, which after the dividends received deduction, it does. Let's skip down to the balance sheet. Notice we have columns for the beginning of the year balance sheet and the end of the year balance sheet. The beginning of the year balance sheet for this company is 0, simply because it's their first taxable year and it was 0 at the beginning of the year before any contributions. The end of the year numbers simply come off our spreadsheet from the balance sheet. Schedule M1 shows our book income and how it reconciles with our taxable income on line 28. In going from book income to tax income, you can see our 5 M1 items: federal income tax, capital gains, charitable contributions, entertainment expense, and officer's life insurance. These are the differences that take us from book income to tax income on line 28 before the dividends received deduction. Schedule M2 is simply a statement of retained earnings, showing beginning retained earnings plus profits for the year minus dividends equals ending retained earnings. Now here's a few things you should always double check on a corporate tax return. First of all, make sure your book income that we show here actually comes from your books before the dividends received deduction. And make sure the income shown on line 10 of Schedule M1 actually equals line 28 of page 1 taxable income. On Schedule M2, make sure that the beginning of year balance for retained earnings equals what's shown on the balance sheet above. In our case, that's 0. Make sure that the net income per books is the same on Schedule M1 and Schedule M2. Make sure that the ending retained earnings shown on Schedule M2 actually equals the ending retained earnings up on the balance sheet. Making sure these numbers reconcile with each other will help prevent an audit. Thanks for watching. In Part 2, we're going to look at some specific calculations of book tax differences and other M1 items. So I'll see you there.